Hello, everybody, and welcome back once again to the Master of Money program. I'm Steve Beeman, your host, and I am so happy to have you with us here tonight. Whether you're joining us live in the office of Harvest Financial Services or whether you're seeing us through some of the Ustream feeds around the internet, we're glad you're spending this time with us tonight. We hope that we bring you the very best in content and information that you need to build a better path to prosperity. So thanks for joining us tonight. We've had a lot going on since last week, and I want to bring you up to speed on just two things that could be very important to you. Most importantly, we're beginning to create a new program for pre-retirees and retirees that's designed to help you know what to do with your assets. It won't be quite as formal as the Master of Money presentation to you. It's more like a talk show. We're going to do it live each week with Tim Newell, chairman of Harvest Financial Services. And the second thing we're going to do is we're looking to create a program for options trading. Some of you who are involved in the markets like to take a little more aggressive approach to your investments, and I'm going to be joined there by Jeff Garbaz of Quantitative Partners. He's also a partner in Superstock Investor that provides us our stock ideas of the week. So we're looking forward to having those programs come on air for you, and if ever there's an idea you have for a show that you'd like to see, we'll send us that at questions@safefinancial.org. That's our email that comes directly to us with questions from our viewers and from our audience and all of the Masters of Money participants. So feel free to write us at questions@safesociety.org. We're glad you're with us. Now, tonight's program has backed off a little bit from last week's complexity. We're going to ease it up a bit, but talk about investing nonetheless. Tonight, we're talking about something called a hybrid annuity. Now that may be a new term to you. Not a lot of people are familiar with the concept, but it's gotten a lot of attention lately because some of the very special investment characteristics that it has. Well, we want to go ahead and show these to you tonight, explain how they work, and explain the good, the bad, and the ugly of these so that you're not bought, or sold, I should say, a bill of goods. A lot of commercials are going on around the country promising 8, 12, 15% returns. Well, we want to show you exactly how that's done. Now, last week, we did show you a program on option strategies. We talked about calls and we talked about puts, the two basic option structures, and how those can be used to hedge your investment positions. We spent a lot of time talking about covered calls, specifically because there are programs out there that promise you 2% a month type returns regularly and almost guaranteed. Well, as we've discussed in prior Masters of Money programs, the actual returns that investors can expect are more in the 8 to 10% a year kind of space. So when people are promising 2% a month, well, that raises our antenna just a little bit. The covered call strategies we talked about can do that. They have an awful lot of very good investment constraints and criteria. But do they always? Well, the answer is no. If there was a perfect investment idea, we would certainly share that with you. But as always, we want you to write us if you have questions about that. We did get a good number of questions about option strategies. That was part of the reason, by the way, we're partnering up with Quantitative Partners and Jeff Garbaz to bring you our new program. We hope you'll tune into that as well, and more information about that will certainly be provided to you as the days move forward. Now, as always, we try to answer a viewer question, and this question that came in related directly to last week's program. And the viewer wrote, I heard a radio program talking about 2% a month profits. Is that real? Well, as we've discussed, I was just mentioning, yes, getting 2% a month is possible. And what they're advertising here are covered call strategies. But when you consider that the average investor earns 8 to 10% a year, well, you're a little bit maybe out on the risk spectrum to generate a 2% a month return. I mean, there is no magic bullet in investing. We talked about with covered calls that, yes, you can earn some money, but you're constraining your returns. Because those stocks can be called away from you, you've limited your upside, and you've only partly hedged your downside. So a covered call strategy, while it can be successful, and we described some of the scenarios for you in which it would be, while it can be successful, again, it's not a magic bullet. So we would caution that particular viewer that, well, yes, it's possible to do it, but tone down your expectations just a little bit. If you make 1% a month, well, you should be happy with that. So with that said, we urge you to continue writing us at questions@safefinancial.org. Now, in the week in review, there is so much going on around the world that it's almost too much to put into a synopsis like we try to do. But last week there was continued focus on this oil issue. As oil prices have come down, there's been a negative impact on a number of countries, most notably Russia. Russia has been increasing its belligerence lately. I mentioned they've flown bomber flights into our North Alaskan air defense zone. They've done several bomber flights into the Norwegian and Finland air zones. And last week came out with some comments that really frightened the Finns. Finland is now talking about it should have joined NATO because it's worried that just maybe Finland is in the sights of Russia's expanding territorial issues. Well, we certainly hope that Vladimir Putin and Moscow will think twice about that, because while Finland may not be part of NATO, it is part of the European Union. And so there are some direct linkages there that come into play. But I believe all of that belligerence is being created by these below $80 oil prices. Russia is an economy that is solely dependent on oil. So as those prices have come down, it's squeezed their economy even further with the sanctions that the United States and its NATO partners have put on because of the Ukrainian situation. So we want to continue to watch it. I don't like to harp about it every week, but it seems to be the #1 geopolitical issue that's going on in the world. So we want to make sure you're aware of it. Let's keep a close eye on it, and we will certainly do that for you here at the Master of Money. The second thing, and this comes out of the Asia Summit a couple of weeks ago, but there's been a lot of talk about China and about China stealing technologies from the West, specifically software and hardware. Now, there was an interesting, I guess you could say, coincidence that came up. During the Asian conference, the Chinese released pictures. Well, I don't know if they released them, but we got pictures of their new fighter bomber. Well, very coincidentally, it looks just like our F-22 Raptor, our brand new next generation fighter. Here are a couple of pictures of those planes. You can decide for yourself if they look as similar as I think they do. So clearly, China is also on the news in the geopolitical sense. In fact, an interesting side note, they're building an island in a very debated waterway with Japan. In the South China Sea and around Japan, there are territorial claims from China and Japan. Well, in one of the Japanese areas, the Chinese are actually building an island. And that island is big enough to house fighter bombers. So it's got the Japanese a little bit concerned. And so like Russia, we keep an eye on China geopolitically to make sure we know where we can maximize our wealth, but also mitigate our risk. If we look, and moving on into the economic issues of last week, I think the biggest note that we have is the XL pipeline was defeated once again in the Senate. Now, if you're not familiar with it, and I've been on the news many times about this, the Keystone XL pipeline is a pipe that's designed to take gas from Canada, oil I should say, developed in their shale, down to our refineries in the Gulf of Mexico, specifically Houston. Well, this pipeline is necessary to transport that oil. But there are those on the other side who say the environmental concerns are such that it's not worth the risk to take that oil down there. Well, on the business side, and that's what we're looking at, the business community would benefit from this. Not just would we create 46,000 jobs in the near term, but in the long run, we'd continue to exploit refiner capacity. And that's not a bad thing. And now, with the U.S. growing in oil production because of our fracking procedures and shale oil production, the fact is we're a net exporter of oil. Well, exports are a way for us to help with our trade deficit, so we would support that as well. So as this vote comes down, or came down last week, we were sorry to see the XL pipeline so narrowly defeated. Now, the reality is in the new Senate that will take place in January, we think it will come up again for a vote. So we would expect in the next go-around, both the House and the Senate would approve the Keystone XL pipeline. We'll see if the president will sign that. I believe with the pressure put on from the business community, he likely will. Secondly, we did some research last week in response to questions and comments and frankly speeches I've made about debt in America. We hear an awful lot about the $18 trillion federal debt, the $100 trillion unfunded liabilities. What is all of this in context? So I did some work, and I thought I'd share with you a couple of numbers that really do put into a concrete sense where this nation stands today as it relates to debt. Well, the number is this. For every man, woman, and child in America, if you take all of our assets, all of them, corporate, business, personal, government, and you add them up and divide it out, we have about $355,000 per American citizen in assets. Now, if we look at that on the debt side, the liability side, it's about $186,000. So if you do some quick math, you have a couple $100,000 of equity per person. Now, that's an optimistic thing. That's good to know. Now, I would share with you, as much as I'm happy about that because we're not upside down, the fact is we are moving in the wrong direction. Our debts are growing faster than our assets right now as a nation, and we have to watch that. Americans do need to save more. Savings is what creates an economic boom, and as much as the Americans can save rather than consume in the near term, longer term will be better off for it. So those numbers I thought were interesting for you. Again, America is not in the dire financial straits that people like to say we are, but we're clearly in an anemic time, a time when the economy is just limping along, not real strong. I would make the argument that part of the reason that it's doing that is this debt structure. We, the American people, need to start saving and hopefully elect politicians who will begin to, or I'll say continue to reduce the deficits down to a balanced budget at some point down the line. Now, the markets last week continue to move into record territory. Both the S&P Dow moved up a little bit, a couple of percentage points, putting them at their record levels. That's a good thing. We should all be celebrating that. Now, it does raise questions about this valuation conundrum that I mentioned to you last week. With the markets now approaching or surpassing 15 times earnings on a gross multiple, it makes you wonder if we're not ready for a bit of a correction. Throw that in with a likely interest rate increase from the Fed next year, and I think we're set up for one. So, to the extent you have equity exposure, talk to us about ways to hedge that. You can buy what are called exchange-traded funds, and we've talked about these at length, that can hedge your portfolio against market losses. That's not a bad idea. So there are ways to hedge it. Don't be shy. Write to us with questions at questions@safefinancial.org. And finally on that, we wanted to make note to you that last week we talked about Cisco. We don't do these stocks of the week as recommendations. We do them as a learning experience on how to look at different things. But we're always pleased when they do work out. And last week, Cisco jumped 2.9% in that week just based on some of those fundamentals we talked about. So we were very happy to see that. And we want to thank our friends at Superstock Investor for providing that stock of the week. So that's kind of the narrow synopsis. Tonight, we are going to, when we come back from our break, though, talk about something that's very interesting in the investment world, and it's known as a hybrid annuity. We've talked at the Master of Money about insurance, about life insurance and universal life and annuities, but this is a bit of a twist on that theme. It's got an awful lot of good things to look at, and it's advertised as, again, a panacea of investing. Well, there are no magic bullets. We'll keep coming back to that. But it may just be that a hybrid annuity has some things for you that work well as part of your strategy. So we're going to look into hybrid annuities when we come back. And we're going to look, as always, at the good, the bad, and the ugly. So stay with us through that. We'll be right back after this brief commercial, but we'll be back and we'll begin our continuation discussions of hybrid indexed annuities.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice with recommendations about how you should invest your assets and plan for your future. They're called robo-advisors. But they're not real advisors because they're not real people. Robo-advisors crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-advisors don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too, but we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Welcome back. You know, insurance, as we've discussed before, can get a pretty bad rap. A lot of times people think they're too expensive or they don't offer quite enough benefits. But we're intrigued by them here at the Society, and we think there's an awful lot you should look at. Unlike perhaps Dave Ramsey or some others, we think insurance can actually provide some really interesting ideas. If we look, for example, at the biggest problems you face trying to accumulate capital, well, on top of that list, to be straightforward with you, is the amount of taxes you pay. For most Americans, the largest single bill they pay each and every year is not their mortgage, it's taxes. And when you earn normal capital gains outside of some kind of a vehicle to protect you, well, you pay taxes on that asset, and therefore it's harder and harder to build it. So we're always looking for ideas that can save you immediately on taxes, whether it's an IRA, a 401k, a KEO, whatever it might be. Insurance is one of those programs that can, in fact, save you right up front on those taxes. Secondly, we right now know, especially if you're in a position where you're retired and you're looking at fixed income, well, we know that you have an enormous amount of interest rate risk. If interest rates stay down where they are, it's extremely difficult for you to earn enough money to survive at 1%. I mean, in Europe now, they're doing -% interest on loans. So the reality is you have to go out and extend longer and longer terms on your debt in order to get paid an interest rate you can survive. Well, the problem that puts in is you have an enormous risk of rates going up. If rates jump up in 2015 from 1% to 4 or 5%, well, the fact is the value of your portfolio, your bonds, is going to come straight down. So you're stuck in a conundrum. You have this drag of taxes, you've got this interest rate risk, and you have market risk. Let's be honest with each other. How would you like to be in a position where you're today 64, 65, 66 years old, and we get another 2009? Well, that would be a disaster. As it was for people 6 years ago, it would be today as well. So you have these problems of taxes, low interest rates, and market risk. And you think, well, what is there that can help mitigate that? How can I take care of some of that so that it doesn't hurt me? Well, interestingly for you, what we're going to explore tonight, this concept of a hybrid annuity with an income rider, and that's an operative term, it actually can accommodate all three of those needs. Tax benefit, higher interest rates than you're presently getting, and a reduction, if not elimination, of market risk. So I want to talk to you about how those work. The basics of an insurance annuity are simply that it's a contract between you and an insurance provider. The importance of this, and what they've done is they've structured these contracts in such a way now that you can put money in. The government looks at it as a tax-preferred item. You're not taxed on the gains in the account, so that's a benefit. So you get the tax benefit, and the way they're structured is you guarantee your principal. And I'm going to explain more in depth on that later, but you actually get a guarantee not just on the amount you put in that you'll get back, that's contractually bound, but as it grows, you're contractually given the greater value of it and locked in at the greater value so that if the market drops from that, you don't pay that price. So you've got tax benefit, you've got guaranteed returns, and you're allowed to participate, let's say, in the upside without any downside. That's a pretty good deal. The other thing, and this has been a problem with typical annuities, is that heretofore, when you bought one in your name, it was very difficult to pass it on to your heirs. Well, these new hybrid annuities that are offered actually give you the flexibility to deal with this and hand it off to your heirs as part of your estate. So you get, again, these three key benefits to these things: tax avoidance, locked-in capital returns, and the flexibility to pass it on to your heirs. That's not a bad trilogy of benefits, if you will. But let's talk about how not everything is often as good as it seems. And again, I mentioned earlier, you see sometimes in commercials, or you hear commercials saying, we guarantee you an 8% return, or a 12, and I've even heard 15% return. Well, they're not really doing that. The more actual guaranteed return on your policy is more like 3 or 3.5%. But the way they do it is called a roll-up value. And we're going to get a little bit technical here, but it's important for you to know. Let's assume you put $100,000 into one of these annuities. What they will do is guarantee you, and the longer you guarantee you'll keep it with them, the higher that guaranteed rate will be. So let's say you go 10 years, and you say, I will give you my $100,000 for 10 years, at which time you then begin paying me out. Well, the insurance companies will say, all right, we will guarantee you an 8% return. If you keep your money in for 10 years, that $100,000 will grow by 8% a year for 10 years. Now, here's where it's tricky. If you pull your money out before that 10 years, well, you don't get the 8%. Again, you're getting more like market returns of 2, 3, 3.5%. So you're not really guaranteeing a rate unless you keep your money in the program. So if you have long-term money and you don't know where else to put it, that would be a time when you want to use this, because you're really locking it up. Now, as you extend out, I'm 50 years old and I don't need the money till I'm 65. Now I have a 15-year window. Well, in those circumstances, the insurance companies will raise that 8% to maybe 12 or even 15% as a roll-up value. Now remember, it doesn't mean that you can go get that money out with that kind of guaranteed return. You can't. But it is there for you when you need to start drawing it. So if you look as a pre-retiree and you say, I want to accumulate, let me digress, and this is important to understand. In the 1970s, we began to see the dissolution of defined benefit plans. Most of you have heard of 401ks. They came through a law called ERISA. What happened is Americans changed and transformed from a defined benefit pension plan, true pension, to a circumstance of self-directed, self-reliant defined contribution plans. So that's a function that you just build savings and then you live off your savings. There's no guaranteed annuitization of the value of it. Annuities give you that. They are truly akin to a defined benefit pension plan. That's their attractiveness. So I want to go back. If I'm 50 years old, 55, and I'm looking at retirement at 65 or 67, it may very well make sense for me, for part of my money, to go into one of these programs because it is akin to a pension plan. I'm an insurance company, there are lots of companies that offer these now. We'll put some of the names up on the bottom of the screen. But if you look at these programs, if you put $100,000 in today, the insurance company can tell you today what your guaranteed paycheck will be every month beginning in 10 years. That's an awful lot of comfort to folks. If you know upon your retirement you don't just have Social Security and you don't just have this pension or this 401k that can fluctuate, you've got a defined benefit coming in. That's a really nice benefit. And these annuities give you that. So that's one of the key advantages from them. Now, the other idea is that if you're a grandparent and you're looking at setting up a benefit for your kids or your grandkids, these insurance programs can give you real benefits, because you can start your kids on an investment program with tax benefits very, very young for very low cost. And that's a benefit to them. So you've got a lot of applications of these things. We always recommend you talk specifically to your investment advisor. we think that's important, or you write us at questions@safefinancial.org. We'll discuss scenarios with you in which case they might make the most sense. But these indexed annuities, and you talk to your advisor about it, most advisors have insurance licenses where they can sell insurance too. For someone who's in a pre-retirement stage, and again, I'm talking to you who's 45, 50, 55, even 60, if you've got some money put away in your IRA, and you've already got that taken care of, you're looking at putting some money away in a protected space, one of these indexed annuities may be exactly right for you. Now again, they're going to guarantee you 8% on the roll-up value, not 8% on the withdrawal value, so be aware of that. But let me touch on this other constraint. I mentioned earlier you can participate in the market growth with some of these, and you can. Some of them are structured in such a way that if you put $100,000 in and you're invested in a variable account, meaning it can be in the markets, if the market jumps up 12% in that first year, well, you're locked in at 12%. You don't give it back if the market comes back next year. You're locked in there. So you get your guaranteed rate, let's say it was the 8% rate, or the market, whichever higher, every year. Now that's a huge benefit because, again, it can protect you from that 2008, 2009 scenario in which the market just completely crashed out on everybody. So as you're thinking about your investment portfolio, and again, especially if you're in that 45 to 60 time frame, look at these things as part of your program to build a defined benefit pension for yourself. How would you like to know right now what you're going to receive in compensation when you retire? It's a very, very comforting thought. But again, you've got to be careful. You don't want to commit your money too long, so you might want to lower that guaranteed rate and then keep your money a little more flexible. So check them out, talk to your advisor about it, or write to us. These are extremely valuable programs, and I think they do bear consideration. So tonight, we've introduced you to something called a variable annuity, indexed annuity with an income rider. It's a lot of words, but there are some extremely strong attributes to these. Tax advantage, guaranteed income, elimination of market and interest rate risk. Those are pretty good benefits for these things. So we want you to think about them, but also don't be caught up in the sales pitches. When they talk about these guaranteed returns of 8, 10, 12%, well, we've talked at length about return expectations with you. As a master of money, you should know that an 8 to 10% return is extremely good. It's almost impossible when interest rates are at 2, 3% for anyone to guarantee you an 8% cash-on-cash return. Well, they don't do that. Again, it's the roll-up value. But that's not bad. That's legitimate. It means in the future you will get back the benefit from that growth. So if you don't have one of these, think about possibly looking into an indexed annuity. And again, make sure it has that guaranteed income rider, because that's what will guarantee you the money coming down the pike. But as you do look at that part of your portfolio, we urge you to call us, write us. The SafeFinancial.org is a not-for-profit organization dedicated to helping you build a better, prosperous life. So use us for that. Join us in our silver memberships. They're of no cost, and you get access to our weekly written reports. You get access to the Safe Financial Network, and you get your questions answered as you need them. Again, you've got a friend in financial services with Safe, and we hope that we can support you in the ways you need. So don't hesitate to write us questions at safefinancial.org. Now, this week there's a lot going on in the country. Yesterday we had the Ferguson verdict in St. Louis, and I know a lot of you are concerned about the ramifications from that. We will keep an eye on that just in how it might affect the American economy. It's a big event, and we know that it's going to have some impact. Secondly, it's Thanksgiving week, and I want to extend to all of you a heartfelt happy Thanksgiving from all of us at the Society. We are trying to help everybody have a better life, and Thanksgiving is the time when we can all look and say thanks for the many blessings we have for our families, our friends, our health, and yes, our wealth as well. So we hope you have a great Thanksgiving week. The Superstock Investor of the Week is going to come through next week. As it's a holiday week, we don't have one for you, but we'll bring that back next Tuesday on the broadcast. So we've got an interesting program next week. We think you'll like it, so certainly stay tuned, and we look forward to seeing you once again on the Master of Money.